Alright guys, so there are three big bombshells we need to talk about, and the first is the debt rollover coming from the US Treasury. It's not a small amount. We are talking about $10 trillion. And since 2020, the national deficit has been spiraling out of control. $3 trillion during the lockdowns, 1.7 trillion in 2023. And that is the amount of money Congress has to borrow to run the country. But those are just the recent borrowings. The sins of the past are coming back to haunt us all. And this has big implications for the US economy and the world. A wall of refinancing, a tsunami of bonds will be hitting the market. Over $10 trillion worth is coming. But this time it's debt being borrowed at vastly higher interest rates. And we know that refinancing your house at a higher rate is never a good idea, right? Your monthly payments go higher and you have panic attacks if you get laid off. But the US Treasury has to roll over this debt. They have no choice because they must forever borrow from Peter to pay Paul. According to the CBO, $1.6 trillion of new debt will be borrowed this year. That's bad enough, but the horror show comes when we look at the existing debt. 8.9 trillion worth of debt is going to mature this year. Add that to the new borrowing, we have $10 trillion worth of refinancing coming in at a new interest rate of 4 to 5.5%. The consequences are deadly, both in the short term and the long term. And let's talk about the big picture first. We know the national debt is unsustainable, it can never be paid back. It's simply a game of musical chairs and postponing financial Armageddon. Buyers of US treasuries are simply people trying to milk the system before the big collapse, myself included. But the day of reckoning is coming. Jamie Dimon calls US debt the most predictable crisis in history. A crisis is coming in 10 years. Eventually, it would cost Americans their homes, spending power, and national security. Notice the emphasis on Americans holding the bag and suffering the most. And that's because the rest of the world is waking up to the big risk of holding US treasuries. Even if we discount the weaponization of the dollar, holding dollar bonds is like hugging a financial time bomb. It's a safe haven asset that will drag you down to hell if you hold it for long enough. Because the debt can never be repaid, countries and investors all over the world are allocating less and less money to US bonds. Foreigners now own only 30% of all outstanding treasuries. Contrast that to 43% 10 years back. This is a clear problem. Yes, some foreigners will be back holders, but the ultimate risk lies with US citizens. US pension funds and all the 401ks buys into treasury bonds no matter the price they are in. And when the eventual default comes, a lot of wealth will simply evaporate. Now, ever since the Federal Reserve has been raising rates, the biggest buyers aren't foreigners. They aren't even mutual funds. The biggest back holders are US households themselves. It's a big reverse in trend, which means America is starting to fund their own debt. Normally, this is a good thing. You are less reliant on foreign funding, so China dumping bonds or Russia never borrowing again won't be an issue. But that is if you are a responsible borrower, which the US isn't. This means eventually, either taxes on US citizens will have to go up, or obligations like Social Security will get cut. And that's what Jamie Dimon was talking about, right? A global rebellion against US bonds is happening, and that is the eventual end game. But in the short term, it's also a big concern we can't ignore. Yellen will be faced with an impossible dilemma. She can choose to roll over the 10 trillion in bonds into either short-term debt or long-term debt. Either move will cause yields to either spike up again or stay higher than usual. Now, most likely, Yellen is going to roll over the debt into short-term treasuries or T-bills. As it stands, treasury bills comprise nearly 22% of total US debt. And this is debt that has a higher yield, which means interest payments on this are higher. And this will mean bond yields in money market funds will take longer to come down or just stay where they are. Now, that's good for savers like you and me, but bad for the banks. It causes money to stay out of the banking system and continue hovering in the money markets. And that makes the banks more shaky and at risk of collapse if a liquidity crisis strikes. But what if Yellen decides to roll over the money into long-term bonds? What if she decides to buy 10 or 20-year treasuries instead? Now, that will be bad for the overall debt situation because you're locking in over 4% rates for the next decade or more. But short term, this pulls money away from the real economy as well. In 2024, US companies have over $100 billion in debt coming due this year. This is corporate debt with an average interest rate of 2.8%, and this is going to go higher if Yellen decides to refinance that $10 trillion debt bomb with long-term debt. In effect, she'll be competing with US companies for investor money. And this won't be good for the real economy and will push real businesses into a credit crisis. Why buy a corporate bond for 6 to 7% yield when I can get 80% of the upside of the benefits for 0% risk in US Treasury bonds? And the higher interest rates are, the harder it is for US companies to survive. There are a ton of zombie companies floating around. In 2022, over 26% of firms are zombies with too little earnings to cover their debt payments. In other words, they don't have enough cash on hand to service the cost of interest. We could see more bankruptcies coming or profits could come down because the cost of borrowing increases. Not a good situation for a market that's priced for perfection, right? Everyone, they're just expecting the best, but if Yellen makes a wrong move, she could really collapse this house of cards. And speaking of freaking out, let's talk about Russia and NATO because there's an epic meltdown going on, right? And if you didn't know yet, Trump, he just opened up a new can of worms. He told the world that Russia can do whatever it wants to NATO countries that pays too little. You can just imagine von der Leyen and Stoltenberg having a meltdown and they're hopping mad. The entire EU is sweating bullets because we are moving closer and closer towards a Trump win. And it's not Biden that's most afraid of Donald Trump winning the elections, it's Europe and the rest of NATO. And if Trump comes back, oh boy, they will be paying through the nose. During a meeting with a NATO country's president, Trump told him or her the unthinkable: I would not protect you. In fact, I would encourage them to do whatever the hell they want. You have got to pay. You've got to pay your bills. And for Trump, it's all about the money, and he's encouraging Russia to do anything they want, even attack. The US has been footing the bill for far too long, and it's time for Europe to pay up as well. It's all about the dollars, and under Trump, this new America won't be subsidizing NATO any longer. The US has the largest military budget in the world, we all know that. It stands at $877 billion, and that is 39% of the global military expenditure in 2022. That's triple the budget of the next regional power, China, and 10 times more than Russia back then. This is the classic guns and butter scenario. The more money that flows into defense is money taken out of the real economy. It's money denied to farmers, manufacturers, and the average worker. America has to spend that crazy amount of money to project power across the world from the Middle East all the way to the Indo-Pacific. And NATO is a big part of this defense budget as well. Trump wants to bring American money back to the US, and that's why Europe is freaking out. They are trapped in a bad situation. And if Trump gets re-elected, they have to protect their own borders now, which means money being taken away from their respective economies. Comparing NATO's defense budget as a percentage of their GDP, many countries still lag behind the US. In 2023, America's defense budget was around 3.5%. The three biggest economies in the Eurozone lags far behind 3.5%. France is below 2%, Germany is at 1.6%, while Italy is only at 1.5%. As a percentage, they lag behind. In absolute terms, they definitely fall behind because the US is a much bigger economy. So it's not unreasonable for Trump to demand Europe to pay for their defense. And this means going forward, we could see the EU scrambling to channel more money into their military. And it gets worse. Trump is planning to slap the EU with trade tariffs to extract more money from them as well. And if Donald Trump wins, the US could punish Europe with a minimum 10% tariff across the board. So importing goods to the US will become more expensive for the Eurozone. And you lump this in with increased defense spending, Europe is about to get squeezed even further. Their cheap energy from Russia is gone. They will have to channel more money to defense, and their goods might get taxed by the world's biggest economy, the biggest consumer around. So this economic stagnation is going to last for years or even a decade or more. It's not a very good time for Europe today. And talking of going broke, there's another country that's in financial trouble, and to no one's surprise, it's Israel. And we said many times before that war is expensive. The longer it drags, the more treasure you'll burn. Israel has been hit with their first ever downgrade. Moody's downgraded Israel's credit rating because the war is pushing Israel closer and closer towards a financial crisis. The market is already pricing in the risk of a debt default. Investors are worried about holding debt from Israel. And the longer Netanyahu wages his war, the bigger the chances of Israel running out of money and defaulting. Credit default swap (CDS) is a form of insurance against default, and Israel's CDS are trading well above countries with even lower credit ratings, lower than even Mexico and Indonesia. Investors, they are buying more insurance against Israel's debt because there's a good chance they might not get paid back. They are burning over $200 million a day, which means in just 5 days, it's $1 billion spent. And this is serious news because if Israel goes broke, it will be the US that will foot the bill. They won't let their biggest ally in the Middle East go down, right? Biden has vowed unconditional support, so Israel's debt burden is also America's problem. Israel is moving to sell a record amount of bonds today to fund their war, and they are beginning to sell more bonds to foreign investors. They have sold around $1.7 billion worth in January alone, and by the end of the year, this could exceed $10 billion. So investors are funding Israel's war, and all these are private placements, so we have no idea who is truly funding Israel. I wouldn't touch these bonds, but there are people out there willing to do it. But what's clear is Israel's bond yields will have to go up sooner or later. It's still trading at similar levels to US Treasuries, which doesn't really make sense. And the longer this war continues, the bigger the gap will get, which is going to push Israel's budget closer towards crisis levels. And there's a reason why war can destroy an economy. Israel relies a lot on the local market for their borrowing needs. The majority of debt is over 80%, which is denominated in shekels, which means taking money out of the local economy to fund the war. And if the war spirals out of control, either the government will be forced to print money to pay off the debt, or inflation will run hot and outpace the bond yields. And as holders of the debt, you are screwed either way, right? So Israel is a textbook example of why wars can drain an economy dry. And the best move is to never wage one in the first place. You avoid a ton of misery and economic pain. Now, if there's one big buyer of Israeli bonds, it's probably the US, and the data confirms it. The Development Corporation for Israel sold a record-setting $2 billion in 2023, $1 billion of which was raised since October the 7th. A big amount was bought by individual US states. According to the organization, most of the money came from state governments including Florida, New York, and Illinois. Even retirement funds are buyers of these bonds. And this brings into question the risk of default, right? It's quite unthinkable for the US government to allow Israel to default because their own states will be on the hook as well. And if Israel can't pay the bill, the burden will ultimately be given to the US taxpayer. They will pay through higher inflation. There will likely be a bailout from the US to Israel. We just need to follow the trail of money to project how this mess will end. And that's why we are moving towards a world of elevated interest rates and inflation. America's deficit spending, plus the two wars today, guarantees a world of economic chaos. Going back to zero interest rates will be impossible, and at the same time, we can kiss goodbye to 2% inflation for quite a while. But let me know what you think, guys. Can the economy withstand Janet Yellen's $10 trillion dump? And what becomes of Europe if or when Trump comes back into office? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.